Okay, this is a continuation of number 7, which we'll cleverly call number 8. And we were talking about threshold margins. Okay, and we developed a formula which looked like this. P, and I put a star, because this is the sort of called break even, was equal to little f plus w times the cost of capital divided by 1 minus the tax rate. So if you look at this, this is the margin you have to beat such that your investment would create value. And remember, we're looking at a situation where we do an investment of f plus w here times sales change, and then you get a bunch of little ones up here, little arrows that go on forever, and they're P, I used a little prime, times 1 minus the tax rate times the change in sales. So if you say the change in sales is $1, this is sort of a graph to create a new dollar of sales. And this number is often 50 cents, and this number in many cases is less than a dime and so forth, and you can sort of see, what do you need to create value? And the present value of this stream has to be this, equal to this, or better, or you will not have a net present value project greater than 0. Now again, this is an approximation for a very specific case. The reason I like to use this is if you look at a company and say last time we calculated when this was 50 cents, and I believed we had a tax rate of 40 cents, 40%, that this became 6.6%. Now, if the tax rate was higher, then obviously this number will go up because you have to make more margin. And in fact, if the tax rate goes to 60%, this becomes 10%, and so forth. And if you're now I was using a cost of capital of 8%. If you're a venture capital person, this number is more like 50%. And for 50%, this margin has to be like 62%. If you can't make 62% on your money, you're not going to make it. But that's not really quite right, because there's growth involved, and we'll look at one more formula about that. So, but before I do that, here's some caveats. First of all, we're using year-end flows only. I find that not to be that much of a restriction when you're calculating something. You can make adjustments. But on the software that we have, you can use beginning year, you can use middle year, you can use the end of the year. It just gets a little trickier to do the math. But that's my second point, is finance folks like me love simple math, or I'll say easy math. And one of the best examples of that is when we talk about the efficient market hypothesis and so forth, and we talk about a mean variance world. That's the old bell-shaped curve. And the reason this is great is because two numbers define that curve. And you know what it looks like. It kind of comes up, and a lot of probability of stuff here, not so much here. All you need are two numbers. You need the mean, where it's located, and you need the standard deviation, or variance. And if you know those two numbers, this thing's defined. Now, there's a lot of math that goes with it, but if you're calculating option theory and various option models and so forth, you make this assumption of the distributions, and everything comes out right. And the math looks pretty good, and it's easy to do. Unfortunately, the real world doesn't work with bell-shaped curves. It turns out that the tails are bigger than expected. So this would come down, and the tails, which means the deviations from the mean, happen more often than not. The so-called 100-year flood happens a lot more after than 100 years. Now, the big problem with dealing all this, we know that, but it's hard to get a real handle on these tails because, frankly, these rare events don't happen that often. Now, if you look at the financial markets over the last year, lots of crazy things happened that shouldn't happen more often than, say, once every 100 years. But that's sort of the way the real world is. So you have to be really careful with a lot of the things we're doing here because there is inherently this mean variance assumption. I mean, another assumption that's made in the markets is the sort of the rational person. They don't let emotions get involved, and that they really not only believe in the efficient market hypothesis and so forth, but they have all of the information. And they have homogeneous expectations. Now, if you think about it, that can't possibly be true because if all of us had exactly the same information, we had all the same expectations, we would never make a trade. So, it's out. Okay, well, that's sort of a little aside. But let me look at a growth situation. Remember we mentioned that the present value was equal to we had dividend 1 plus k plus dividend 2, 1 plus k squared, etc. Okay, now what if dividend 1 equals dividends, say the original dividend, 0 times 1 plus a growth rate. And dividend 2 is dividend 1 times 1 plus g. Okay, now I don't think you have to think too hard to see that what you'll end up with is something that looks like dividends, so we'll call that dividend 0. And what we have is 1 plus g over 1 plus k plus 1 plus g over 1 plus k, both of them squared, and etc. It goes on. Let's say it goes on forever. Okay, now if you sum this, what you end up getting is 1 over k minus g. So this then equals dividend divided by k minus g. That's the PV, that's the so-called growth formula. All right, now look at that. Now this is assuming infinite growth. Okay, now what happens, normally k for this kind of formula to work has got to be greater than g. I mean, think about it. If k is got to be greater than g, then the denominator is always going to be bigger than the numerator, and so as you go out, you could convince yourself that even though you have an infinite number of terms, that this one will always be bigger than the bottom will be bigger than the top, and they will eventually sum to a finite thing, which it does. But what happens if k equals g? If k equals g, then this is 0. In fact, if k gets real close to growth rate gets real close to k, this comes to 0 and this thing blows up. Here, PV is infinite. And what happens about g greater than k? It's the same thing. Only now the formula would look strange. But if growth rate, I mean, just look at this formula. This is no good anymore, because when you the assumptions you use when you sum this thing, you always assume that k is greater than g. So if the growth rate, like for a startup and stuff, which is huge, will be much greater than k, hopefully, this formula doesn't work. This only works when you're looking at something that's going to go on forever and where k is greater than g. So I'll stop right now, but just remember that's a big caveat here.